Assalamu alaikum, dear students. Welcome back to the class of Introduction to Business Finance. Today is our second lecture. In the last week, we had first lecture of the business finance. In the first lecture, we studied the overview of the financial management, the definition of the financial management, the three main decisions of the financial management, the investment decision, the financing decision, the management decision. The first decision, the investment decision, which was the left hand side of the balance sheet, which contain the current assets and the fixed assets. The financing decision was the right hand side of the balance sheet, which also has current liabilities and fixed liabilities plus owner's equity. The management decision was the management of right hand side of the balance sheet and left hand side of the balance sheet. Another concept which we discussed in the first lecture was the modern corporations. We also discussed the modern corporations, that how the modern corporations exist in the world. Another topic we also discussed, that was agency problem. The agents, that we said that agents are the working for the best interest of the owners. Today, in today's lecture, we discuss three main topics. The first topic is the business environment of the organization, the tax environment of the financial management, and the financial environment of the financial management. Let's start with the business environment of the financial management. In the business environment, if you remember, dear students, you have studied, you are familiar with the business environment of the financial management. In business environment, you have studied that there are four types of the businesses. In US, there are four types of businesses. If you remember, maybe possible you have studied in the introduction to business subject the types of business. Maybe possible you have studied in the principles of management subject the types of business. But here we only overview those types of businesses. That in US we have only four types of businesses: the sole proprietorship, the partnership, the corporation, and limited liability companies or limited liability corporations or LLCs. First, the sole proprietorship. In sole proprietorship, you better know about the sole proprietorship that there is only one owner. There is a single owner only. Single owner is liable for the all the debts of the organization, all of the debts of the business. He only the person who runs the business. The owner is liable for the all of the debts of the business and all liabilities of the business. He is liable for all of the liabilities. It means thus only that only owner runs the business. He is liable for the profit of the business. He is liable for the loss of the business. He is liable for the paying of the tax. Every activity is done by the owner. Oldest form of the business organization, and the tax is accounted and the tax is calculated and the tax is paid to the government only one time as a personal income tax. As a personal income tax. Second is partnership. You have also studied about the partnership, a business form in which two or more individuals act as owners. It means that if we have more than one owner, that type of the business is called partnership. 2 to 5 to 10, maybe possible 15 persons come together, invest in a business. These partners, these owners are liable for all of the debts of the organization. They also run the business and they are also owners of the business. Again, they only pay once tax in the year, accounted for each partner's personal income tax. They are not going to pay two types of tax. They are not going to pay twice in the year. So only pay they only pay the personal income tax. Third form of the business is corporation, a business form legally separate from its owner. We also studied in the first lecture of the business finance, if you remember. We said that in agency problem there are separation between the owners and the management. Management is liable for all of the organization. If you remember, I have told you that CEO and board of members, board of directors, the members of board of directors and the top management, they are final responsible for the organization. For the loss and for the profit, they are responsible of the organization. So owners are only liable for the profit and loss. If the business is gaining profit, the profit is distributed among all the shareholders, among all the owners. If the organization is getting loss, so the loss is accounted, loss is distributed among all the owners and all the shareholders. So owners are not liable for the all the activities of the organization. There is exist separation between the managers and the owners. It is an artificial entity that only can own assets and incur liability. The shareholders, the owners of the organization, only own the assets and only own the liabilities. Other than liabilities, they don't have any activity in the organization. So income tax is accounted twice in corporations. Once they pay the corporate tax, this is paid by the organization. The second is personal income tax, which pay the owners of the organization to the government. So tax is calculated twice for the organization. The fourth form of the business is limited liability companies, LLCs, or limited liability corporations, a business form that provides its owner called members with corporate style limited personal liability and the federal tax treatment of partnership. So it is the combination of partnership and corporation. Limited liabilities are the combination of partnership and corporations. Why? Its style is, the business style is same like corporation, but its tax payment is same like the partnership. So partnership pay only one tax, LLC also pay only one tax, but its style of the business is same like corporation. It means that there is separation between the owners and the management. Business is run by management, not by owners, but tax is paid by owners, not by management, not by organization. So this is called limited liability corporation. Individual income tax is paid to the government. Next environment is the tax environment. Dear students, the tax environment is a little bit complicated. So please give a more concentrate on the tax environment. The tax environment of the financial management is the environment that only pays tax to the government, which we talked before in four type of the businesses. That in first type of the sole proprietorship, the income tax is paid to the government. The second type of the business, that was partnership. In partnership, again the income tax is paid to the government. In third type of the business, that was corporation. In corporation, the organization is also paying tax to the government, that is corporate tax. And now how we calculate this corporate tax, how we calculate the corporate income tax for the organizations. So this chart shows that we can calculate our corporate tax on the basis of this chart. This chart is international chart, but mostly used in the US. All of the organizations of the world calculate their tax on the basis of this chart. This is a international method for the calculating of the tax rate. It is a international method. Every country uses this chart to calculate the tax, corporate tax for their organization. But the tax rate differs country to country. Tax rate differs country to country. In Afghanistan, every organization who is earning profit less than 5,000 till 5,000, they are not liable to pay tax to the government. But if their profit increases from 5,000 and reaches to 10,000, they are going to pay 2% tax to the government. If their profit increases from 10,000 to 20,000 and reaches to 20,000, they are going to pay 5% tax to the government. So tax rate differs. If we look to this chart, this is a US based chart. So in US, every organization which is earning the profit from 0 to 50,000, they are going to pay 15% tax to the government. So if we apply 15% tax to the 50,000, it becomes 7,500 rupees. Then if any business whose profit is more than 50,000 till 75,000, they are going to pay 25% of tax. If an organization is earning profit more than 75,000 and its profit reaches to 1 lakh, so they are going to pay 34% tax. But there is a one point, dear students, there is one point you must concentrate on that. In this chart, we only pay 15% on 50,000 rupees. If we increase our profit from 50,000 to 75,000, then we are going to pay two types of tax. One 15% on 50,000, second is 25,000 on 25% on 25,000. It means that we are going to pay 15% tax on 50,000 and 25% on 25,000. There exist two types of tax rates. If our profit increases from 75,000 to 1 lakh, then we going to pay three types of tax. One on 50,000, second on 25,000, third on again 25,000. First in 50,000 we have to pay 15% tax, and second 25,000 we are going to pay 25,000, and third 25,000 we are going to pay 34%. So these three types of tax is paid. Such as in 50,000 we are going to pay 15% tax, so 15% of the 50,000 becomes 7,500. So next we are going to pay the tax on 75,000. In 75,000, in 50,000 we are going to pay 7,500, and 25,000 we will pay 25%. So it becomes 7,500 plus 25% on 25,000. So it becomes 13,750. And 1 lakh, then in 75,000 it becomes 13,750, and increase 25,000, marginal 25,000 is charged by 34%. It means that 13,750 are old tax plus new tax is 34%, which is 0.34. Then it becomes 22,250. If our income increases from 1 lakh till 3 lakh 35,000, then we will pay 39%. So there is 39%. So in 1 lakh we pay 22,250. The marginal 2 lakh and 35,000 we pay 0.39 or 39%. So it becomes 11,000, 1,13,900. Then if our income or taxable income or profit increases from 3 lakh 35,000 to 10 lakhs or 100 lakhs, so we will pay 34% tax. Why? Because our fixed rate is increased. Fixed rate is increased to 1,13,900. So we will pay the more of the marginal tax, that is 34%. Till 3,35,000 we only pay 1,13,900 tax. The marginal tax rate from 3,35,000 is 34%, and so on till the end. So let's uh, learn an example of the tax. The Liza Miller of Basket Wonder BW is calculating the income tax liability, marginal tax rate, and the average tax rate for the first fiscal year ending December 31. BW's corporate taxable income is 2 lakh and 50,000. Now you can easily find out the tax of the 2 lakh 50,000. How? Let's start. If you remember, in 1 lakh we had 2 lakh 2,250 rupees. Marginal 2 lakh we have taxable income 2 lakh 50,000, and 1 lakh we have 20,000 and 250, and 2 lakh 50,000 we minus 1 lakh. The remaining 1 lakh and 50,000 we apply how much? 0.39. It means 39% of tax. So in 1 lakh, multiply by 0.39, it becomes 58,500. So 22,250 was in 1 lakh, and 58,500 is in 1 lakh and 50,000. So both we add up both, it becomes 80,750. So marginal tax rate is 39, because in 1 lakh we have already applied three types of tax rates. In marginal 150 lakh we apply marginal rate, that is 39%. Average tax rate, we divide simply the tax on the taxable income. 80,750 divided by 2,50,000, it becomes 32.3%. So average tax rate is 32.3%. Simply multiply 32.3% to the 2,50,000, it becomes 80,750. So average tax rate is 32.3%, marginal tax rate is 39%, and how we calculate we discussed before. So in the end of the class I will provide some more examples as an assignment to you guys. Now the second concept of the tax is handling corporate losses and corporate gains. What are the corporate losses and corporate gains? Corporations that sustain a net operating loss can carry that loss carry back for 2 years and carry forward for 20 years to offset operating gains in those years. So if a business is going in loss, so its loss is carried back to the past 2 years. Carry back and carry forwarded for 20 years. For past only 2 years, there is a law that you cannot carry back to 3 to 4 to 5 years. You only carry back to 2 years and carry forward for 20 years. Corporate gains are the profits of the organization, and corporate losses are the losses of the organization. So losses are generally carried back. First loss is carried back, then carried forward to the future. First and then forward, starting with the earliest year with operating gains. Let's learn an example of the corporate losses and gains. Liza Miller is examining the impact of the operating loss at Basket Wonders in 2003. The following timeline shows operating income and losses. What impact does the 2003 loss have? Let's start with the timeline. In the year 2000, BW earned 1,50,000. In 2001, the BW Corporation earned 1,50,000. In 2002, the business earned 1 lakh rupees. But in 2003, the business was in loss by 5 lakh rupees. Now, what we can do with the loss of 2003? We only carry back the loss of 2003 to the 2 years back. We cannot carry back to 3 years. It means that we can get the tax which we have been paid to the government. in 2001 and in 2002. In 2001, we paid tax to the government by 150,000 tax. And in 2002, we paid tax to the government for 1 lakh rupees. So we can carry back this 5 lakh rupees to first to the 2001 and 2002. Same like in the one, we cannot get the tax back from the government in the year 2000, 150 lakh, but we can get our tax back from the government in 2000, for the profit of 2000 and for the profit of 2002, for the profit of 2001 and for the profit of 2002. That is, we have loss in 2003 of 5 lakh rupees, so we can carry back to the 2001. In 2001, we had 1 lakh 50,000 profit, we minus from 5 lakh rupees. Again, in 2002, we had a profit of 1 lakh rupees. Again, we minus 1 lakh. 1 lakh plus 150 lakh, it becomes 250 lakhs. And now we have loss of 5 lakhs. We subtract 2 lakh 50,000 from the 5 lakh. It means that we got back the tax of 2 lakh 50,000. Now we have loss of 2 lakh 50,000. We will carry forward in the future. If we earn 1 lakh rupees in the 2004, we will not we are not able to pay, we will not pay any tax to the government. If we have profit in 2005, a profit of 3 lakhs rupees, so we covered 1 lakh rupees in 2004, and we are going to cover more of 1 lakh 150 lakh rupees in 2005. We will pay only tax in 1 lakh 50,000 because we have profit of 3 lakhs rupees. So this concept shows us that the government have a subsidy to the government, to the organization, that if you are in loss, you can carry back your loss to the 2 years in the future, in the past, and for the future you can carry forward your profit for the 20 years. Clear? Now third environment of the financial management is the financial environment. The financial environment is the financial markets. Business interact continually with the financial market. So financial market is true necessity for the organizations. Organizations, corporations are always touched with the financial markets, are which always connected with the financial market. What is financial market? The financial markets are composed of all institutions and procedures for bringing buyers and sellers of financial instruments together. And now, what are financial instruments? You better know about the financial instruments: the stocks, the bonds, the debentures, the treasury bills. They are financial instruments by which we can raise our fund for the organization. So, financial market is a market where buyers of these instruments, which are bonds, debentures, and stocks, shares of the organizations, treasury bills, treasury notes. So seller of these and buyer of these financial instruments together in a one place. Therefore, this is called financial market. Financial market is a market where buyers of the financial instruments and sellers of the financial instruments are brings together in a one place. So the purpose of financial market is to efficiently allocate savings to ultimate users. If I have savings, if I have money, if I have savings with myself, then I can invest this savings in the financial market. So I am buyer of the bond. I may be possible. I will be buyer of the stocks of the organization. I will be buyer of the bonds of the organization, the debentures of the organizations, the treasury bills of the government. So I am saver. So I have money. So I am a buyer purchaser of the financial instruments. And in financial instruments, may be possible the Nokia is issuing bonds in the financial market. So Nokia is seller, I am buyer. So saver and buyer are brings together the financial market. So saver allocates efficiently their savings in the financial market. I hope you are getting my message. Flow of funds. In financial market, we study flow of funds. It means we study different types of financial market. First is investment sector. Investment sector may be possible. Government first is businesses investment sector. You can invest your money in business. You can invest your money in government. Before I told you treasury bills. Treasury bills are offered by the government. The households are also investment sector. Second comes the saving sector. Households, and first comes the households. Households always try to save their money. The businesses also try to save their money. And the government also want to save their money. So, saving sector is the households, businesses, and the government. Next come the financial brokers. Financial brokers are those who act as a middleman. Financial brokers are the middlemen. Intermediary. They are intermediary. The financial brokers. The brokers, the person who brings the bankers who brings the buyers and sellers together in a market. So they are called financial brokers. The persons, the bankers who brings the seller and buyer of the financial instruments, they are called financial brokers. Financial brokers. So in financial brokers, there are two types of bankers: investment bankers and mortgage bankers. Investment bankers are those who brings the buyers and sellers in the financial market. So investment bankers are the bankers who buys the shares in a lump sum in a wholesale from the organizations and sells these financial instruments to the individuals. They are called investment bankers. Investment bankers are the financial brokers. They purchase the shares of the organization in a wholesale. Then they sell these shares, these financial instruments to the investors individually. So they earn profit. They purchase it. For example, they purchase the whole shares of the Nokia by $10. One share by $10. The Nokia offered 1 lakh shares. So the bankers, the investment bankers, purchase all the shares of the Nokia organization per share by $10, and they will sell these shares in the market individually by $12. So the $2 is profit for the investment bankers. So investment bankers mostly work in the bonds and stocks. Second is mortgage bankers. The bankers who invest in the real estate. In the real estate. So in real estate, they buy the real estate, buy the different types of the mortgages from the mortgage providers and sell back to the mortgage buyers. So they earn profit, they earn commission between them. So they are financial brokers. Next come the financial intermediaries. Financial intermediaries are also the middlemen. Also the middlemen, but there is difference between the financial intermediaries and the financial brokers. Financial brokers deals only in these financial instruments such as bonds and stocks, but financial intermediaries are the banks and the financial institutions who are not involved in the buying and selling of the bonds and the financial instruments, but they pool the money from the individuals and then invest in the financial market. They pool money from the individuals, then this pooled money is invested in the financial market, and when they buy the bonds, the debentures, the financial instruments in the financial market, but they get the money, they pool the money from the individuals, such as commercial banks. Commercial, you can better know about the commercial bank, that commercial banks make the current deposits, current accounts, the fixed accounts. Everyone save their money in the commercial banks. Then commercial banks pools these money and invest in the financial market. So commercial banks, savings institutions, all the institutions who save the money of the individuals and then pool this money and invest in the financial market. Insurance companies, you better know, Bima, insurance companies. Insurance companies also pool the money from the households, from the individuals, and invest in the financial market. The pension fund. Pension fund is also the money which is pooled from the all the employers of the government. So this pension fund is pooled and invested in the financial market. Finance companies, the companies who provide microfinance jobs to to the individuals. Microfinance, the loans to the individuals. So they are also financial intermediaries, and mutual funds also financial intermediaries. Next is the secondary market. The secondary market is a market where already existed stocks are traded. Secondary market, such as security exchange market and over the counter market, OTC market. In security exchange market, the example of security exchange market is stock exchange market. New York Stock Exchange Market, Japanese Stock Exchange Market, New Delhi Stock Exchange Market, Karachi Stock Exchange Market, Lahore Stock Exchange Market, Islamabad Stock Exchange Market. They are stock exchange. The stock exchange is the systematic, the organized place where all the organizations are listed in that stock market. It's organized and a mechanism. There is a mechanism to list, to register your organization in the stock market. This is an organization, organized place. Second type is the over the counter market. Over the counter market is a market that is not organized market. That is not organized market. The organizations which are not listed in the stock exchange market, they sell their bonds. They provide, they offer their bonds, they offer their shares, their stocks in the over the counter market. So this is not an organized market such like the stock exchange market. The over the counter market is operated by the Nasdaq. So over the counter market is a market which is not organized. The organizations who are not listed in the stock exchange market, so they sell their bonds, they purchase another bonds in the over the counter market. Thank you, dear students. Today's lecture was the three environments of the financial management. First was the business environment, in which we studied the four types of the business: the sole proprietorship, the partnership, the uh, corporation, the limited liability companies. Second environment was tax environment, in which we discussed two main topics. First was the calculation of the tax, and second was the carry forward, the corporate loss and corporate gains, carry forward and carry back. Third environment, we studied the financial environment. In financial environment, we studied the financial intermediaries, the financial brokers, the secondary market, the investment bankers, the mortgage bankers, the over the counter market, the stock exchange market. So these are all concepts which we discussed in this chapter. So I hope you will learn from my explanation. Thank you so much. Thank you very much, and have a nice time. You can find out this video from my YouTube channel. Have a nice time. Have a good day.